at the end of every 10 minutes or 15 minutes. So if you have any questions or clarification, please use the chat window so that I can answer them. Okay, now if in the entire project management body of knowledge, if somebody asks me which are the two key things which really interest me as a trainer, I'll say it is the earned value management and the critical path. So if you can be very solid on earned value management and critical path, then 80% of the problems can be really anticipated or managed well as a project manager. So as stated here, it is a methodology that ensures project progress by comparing the actual schedule and cost performance against planned performance as laid out in the schedule and cost baselines. The beauty of this is this is a composite ratio which has both the elements of time and cost. So earned value management will tell us whether we are we ahead or behind schedule, and when is the project likely to be completed? Are we under our budget? How efficiently are we using our resources? What is the remaining work likely to cost, and what is the entire project likely to cost, and how much will be under? How much will be we will be under our cost or under cost when we complete the project? So it gives us the current snapshot of the project. At the same time, it helps us to slightly forecast about how much it is going to cost when we really complete the project. These are the basic definitions. We'll come back to these definitions later. Maybe let us see this particular example where we are doing the review of the project. Let's say 1 minute. So we are doing the review of the project here. That means as on the review date, I'm supposed to complete this particular work package, this particular work package, this, and this. So as on the review date, I'm supposed to complete work worth 10. So by assuming each of these work packages have a budget of 2, it can be 2,000 US dollars, it can be 2 lakh Indian rupees, whatever it is, the cost is the budget for those work packages. So this work package has a cost estimate of 2, this has a 2, this has 2, this has 2, this has 2, and the sum of this is 10. So the plan value is 10. Plan value is also known as budgeted cost of work schedule, BCWS. And let's say this work package we have completed, this we have completed, this also we have completed, this we have completed, and this we have not completed. So earned value earned value is 8. Earned value is nothing but the budgeted cost of work performed. So here it is the budgeted cost of work schedule, here it is the budgeted cost of work performed. Now this work package is done, and for that I incurred only 1.5, let's say. Here I had a budget of 2 and I incurred only 1.5. Here also I had a budget of 2, I incurred 4, that means I exceeded the budget. And here I had a budget of 2, but I exceeded. I consumed 4. This work is not started yet, but I spent maybe 2. So the actual cost is actual cost of work performed. So in this case, it will be 1.5 plus 1.5, that is 3 plus 4, 7 plus 4, 11. So actual cost is 11 in this particular case. This much is it clear? If this much is clear, we can proceed further. Otherwise, I should be explaining it till this is clear, because there is no point in proceeding further without understanding this. Yeah, so this much is clear. If it's clear, just type in yes, and if you have any questions, maybe you can type in those questions as well. Okay, so here we are talking about plan value. Plan value is 10, earned value is 8, and actual cost is 11. So if you know these two ratios, these three ratios, then using this basic building blocks, we can work out schedule variance is earned value minus plan value. So in our example, earned value was how much? In the previous slide, our earned value was 8, plan value was 10, and actual cost is 11. So if you put these values here, my schedule variance will be earned value minus plan value, 8 minus 10. So in this case, we will get a variance. So here it will be 8 minus 10. So earned value minus plan value. Earn was 8 and plan was 10. SPI will be earned value by plan value. That will be 8 by 10, which is 0.8. And cost variance will be earned value minus actual cost. That is, earned value is 8 minus actual cost was 11 in our case. And CPI, cost performance index, will be earned value by actual cost. That is 8 by 11. That is cost performance index. And schedule variance percentage will be SV by PV into 100. The SV is earned value minus plan value. That is minus 2 by plan value was 10 into 100. So this will tell us that this project was minus 20%. This project has a schedule variance of minus 20%. That means we are lagging behind by 20%. An easy way to remember all these ratios is always earned value comes first. Schedule variance is earned value minus plan value. Schedule performance index is earned value by plan value. Cost variance is earned value minus actual cost. And cost performance index is earned value by actual cost. And schedule variance percentage is earned value by plan value into 100, which is nothing but earned value minus plan value by plan value into 100. So how do we interpret these ratios? Anything less than 1, generally speaking, anything less than 1 is bad. That means if SPI is less than 1 means I have a schedule variance. And CPI less than 1 means I have a cost variance. SPI less than 1 means I'm lagging behind schedule wise. And CPI less than 1 means for the completed work I've spent more than the budget available. There's a cost overrun. So generally speaking, anything less than 1 is bad. Anything greater than 1 should be good. That means SPI greater than 1 means I'm ahead of schedule. That means if I have to get a positive SPI, my earned value should be more than the planned value. So I should have completed more work than planned. In that case, schedule variance becomes positive. That means I am ahead of schedule. Whereas cost variance, if I have to get a positive number, that means I should have completed the work without consuming the budget. In that case, I'll have a positive cost variance as well, or CPI as well. So generally speaking, if SPI is 1 and CPI equal to 1, the project is going perfectly schedule wise, as well as the project is going perfectly cost wise. Anything above 1, okay, that is fine. SPI greater than 1 means the project is ahead of schedule, and CPI greater than 1 means the project is progressing without consuming the budget allocated, which is a good sign generally. And anything less than 1 is bad. If SPI less than 1 means the project is lagging behind schedule wise, and CPI less than 1 means the project has spent more money than budgeted. So these ratios becomes very, very handy. And talking from the implementation perspective, generally people ask this question, like should we track earned value at an activity level, or should we track an earned value at a work package level? My recommendation would be ideally, okay, it needs to be done only at a work package level. When we translate these work packages into a schedule, by and large there can be a mapping between your work packages and the milestones. So if you can track this at a milestone, that is perfect, because work package itself is micro. If you remember that 880 rule, our work packages itself will be between 8 hours and 80 hours of effort. So tracking this at a work package level or at a milestone level is ideal, whereas tracking a project at an activity level may end up in doing micromanagement, because when the milestone itself is only 8 hours duration, tracking at a lower level may not be very, very effective. So this work package sizing becomes of high importance while rolling out an earned value management implementation within an organization. Yep, so I need a kind of reaffirmation from you. If things are fine, please type in yes. If you have any questions, okay, please ask me those questions so that I can answer them. Yeah, do you have any questions? Is it clear to you? Yeah. So one question was, okay, please go to the previous slide and explain if actual cost is 11 or 13. Okay, that's a good question. So the definition of actual cost is actual cost of work performed. Sorry. The definition of actual cost is actual cost of work performed. So in our case here, see, if you take the first work package, okay, this is done, this is completed, this is second one is also completed, third one is also completed, fourth is completed, fifth is not completed, but still we have spent some money against it. It means, okay, we might have given some advance for some raw material or so, but that work has not started yet. That's why it is in red color. So earned value is the budgeted cost of work performed. So in this case, our earned value is 2 plus 2, 4 plus 2, 6 plus 2, 8. This the last work package I'm not taking because that work is not performed. And likewise, if you really look at the actual cost for the first work package, we incurred a cost of only 1.5. Second, we incurred a cost of 1.5. Third, we incurred 4. Fourth, we incurred 4. And fifth one, the work is not completed yet. But at the same time, we might have given some advance, as I discussed earlier. So in that case, this 2 is not counted. So actual cost is actual cost of work performed. So in this case, the actual cost is 3 plus 4, 7 plus 4, 11. It is not 13, it is 11. Because actual cost is actual cost of work performed. So it goes like this. It is not it is not very difficult. It's in a layman's language. It is like during this particular review date, what is the total value of work we scheduled? So in this case, it is 10, 2 into 5. Out of that, how much did we complete? That is 8. 2 into 4, that is 8. And the last question is for the completed work, how much did we spend? So in this case, for the completed work, we spend only 3 plus 4, 7 plus 4, 11. So we planned for 10, we completed 8, and for that we spent 11. So I think that makes it clear. Okay, great. So let us proceed. Yeah, so at least from tomorrow onwards, if somebody is reporting a schedule variance to you, that person should be able to explain to you, what is the numerator and what is the denominator. So if somebody says schedule variance is 10%, then you should be able to tell you what is earned value and what is EV and what is PV and how did he arrive at it. Or if somebody says that there is a 10% variance, then also that person should be able to explain to you all these things. But if that person is unable to explain, that means the reporting is not very accurate. So this will help you to ask the right questions, because you need not ask too many questions to understand the health of a project. All you need to ask is what is the schedule performance index and what is the cost performance index. If both are positive, it's a good sign. If there's a negative thing, it's a bad sign, and we should take some action on it. So it is as simple as that. Now coming back, say sometimes this is perfect. Okay, when it is a construction company and all, because percentage completion business is reported by a separate audit team or a survey team. Whereas in an IT kind of a project where most of the things are not visible, everything is inside a computer, then these things may not work. We need something smarter, because even if somebody can easily report wrong numbers. So in an IT we need something better or smarter. So here, see, companies can follow a 0-100 rule. When I say 0-100 rule, when you start counting the earn value, either if something is completely done, I will treat it as earned. But if something is partially done, then the value of that will remain as 0. So it can be either 0-100. Some companies will follow a 50-50 rule. That means when you start a particular activity, you can treat it as 50% is done, and the remaining 50% will be counted as earned only when it is done 100%. That is 50-50. Or companies can even go with 20-80 or 80-20 and all those things. In this particular example, we are following a 50-50 rule. So let's try to understand what is 50-50. When we say 50-50 rule, when I start a particular work, I can consider it as 50% is completed, and the remaining 50% can be treated as done only when it is 100% is completed. Even when it is 99% is completed, the earned value will remain at 50. Or when it is only 10% is completed, the earned value will be 50. And even if it is completed 99%, that earned value will remain at 50. And the 100 will happen only when it is 100% is done. So that is the significance of a 50-50 rule. So for this particular project snapshot, we are following a 50-50 rule. So here we are doing the review of the project here. And the slanted line is the planned work and the dark line is the actual completion. So now if you take activity A, as on the review date, here this is the review date. As on the review date, I'm supposed to start it and complete it as per the plan, and I've started it and I've completed it. So my plan value will remain at 6,000 and earn value will be also 6,000 because as per the plan I'm supposed to start and complete it before the review date, and I've started and completed it. So plan value is 600 and earn value, plan value 6,000 and earn value is also 6,000. Let us take the next one. As on the review date, I'm supposed to start it and I'm supposed to complete it before the review date, and I've started it. So in this case my plan value will be 50,000 and earn value will be only 25,000. So here it will be 25,000. Here it will be 6,000 and 6,000. Plan value is 6,000, earn value is also 6,000. Here C, if you understand C, then okay, that means you have understood the whole concept. So here again this is a review date. As on the review date, I'm supposed to only start it, and I've started it. And my plan value for C will be, as on the review date, I'm supposed to only start it. So my plan value will be how much? Can you type in your answer? For activity C, how much will be the plan value? Yeah, that is wonderful. So Nia said, okay, it is 6,000, and I fully agree with it. So as on the review date, since I'm following a 50-50 rule, I'm supposed to only start it. So my plan value itself is only 6,000, and earn value will be, I've started it, and maybe, yeah, so my earn value is also 6,000. Plan value 6,000 and earn value is also 6,000 for activity C. Then for activity D, as on the review date, I'm supposed to just start it. So what will be the plan value? What can be the plan value? Plan value will be again 6,000. Sorry, 8,000. As on the review date, I'm supposed to only start it, and earn value is also 8,000. So for activity D, it will be 8,000 and 8,000. I hope that is clear to you. If it is not clear, I can repeat. So if you have any questions, please ask. So we are not going by the apportionment. It is like we are following a 50-50 rule. 50-50 rule states very, very clearly, like when I start an activity, I can take 50% credit, and the remaining 50% credit I can have only when it is 100% done. So based on that 50-50 rule, when we count the earn value for this particular for this particular project, for this particular project, when I apply 50-50 rule, these are the values we get. For activity A, plan value 6,000, earn value 6,000. For activity B, plan value 50,000, earn value is 50,000. For activity C, plan value 6,000 and earn value is also 6,000. And activity D, plan value is 8,000 and earn value is also 8,000. So now I'm getting a question, like on what basis we choose whether to use 50-50 rule or something. So that is a management decision. So there is no specific criteria for that. So a corporate can decide whether they will follow a 0-100 rule or a 50-50 rule or a 80-20 rule or a 20-80 rule. If nothing is provided, then you go by the percentage completion. Okay. So if you have understood how to count this earn value and plan value, then we can proceed. If nothing is provided, we should go by the percentage completion. In that case, for activity A, plan value 6,000, earn value 6,000. Activity B, plan value 50,000, earn value 25,000. Activity C, plan value 6,000, earn value 6,000. And activity D, if nothing is provided, it should be plan values 4,000 and earn values 4,000, because we are going by apportionment and the percentage completion. In this case, they've told us that they're following a 50-50 rule. So the earn value calculation also will slightly change. So here activity A, no impact, plan value 6,000, earn value 6,000 if you're following 50-50. Activity B, plan value is 50,000, earn value is 25,000. Activity C, plan value is 6,000 and earn value is also 6,000. And activity D, plan value is 8,000 because of 50-50 rule, and earn value is also 8,000. So that's how it is done. If you have any questions, please type. Okay, so let us proceed. This is the summary. So I don't want to confuse you, because here, see, the numbers here is wrong. So the totals are fine, but the individual numbers, if you see, there are some mistakes which I should correct. I will not correct, because I don't want anybody to use the slides. So somebody is using the slides for a presentation, that person should fail. So that's why intentionally I've given something wrong. The totals are correct. So based on the 50-50 rule, if you add up, the total plan value is 70,000, earn value is 45,000, and the actual cost is 65,000. So using these numbers, if you plot a graph, it will look like this. So as on the review date, I'm supposed to complete work worth 70,000, and I have completed work worth 45,000 because I'm here. This is the earned value. This is the planned value. And for completing this 45,000 worth of work, I incurred an actual cost of 65,000. So I'm in real trouble now because planned was 70,000. I'm supposed to complete work worth 70,000, and I've completed only 45,000 worth of work, and for that I incurred a cost of 65,000. So I'm in real trouble because my SPI is less than 1 and the CPI also is less than 1. So that way I'm in trouble. Yeah. If both SPI is 1 and CPI is 1, all these three lines would have intersected at this point. Both SPI is 1 and CPI equal to 1. All of these three lines would have intersected at this point. At least if CPI was 1, earned value and the actual cost would have intersected at this point. So then at least cost-wise you're okay. Now in this particular scenario, both CPI and SPI are not equal to 1, then you are in trouble because schedule-wise you are lagging behind, and cost-wise also you're overrun the budget. So we are in real trouble in this particular scene. To understand this, actually it is very easy if you're following this 2020 cricket and all. Plan value is the target set by the first team, and earn value is you're chasing the total, that is the earn value. So plan value is the target set and earn value is the actual achievement of the target. Actual cost, I don't know, I don't have anything to compare. Whereas for plan value is the target set and earn value is the actual achievement of it, the worm. We are talking about the worm. So as long as this earned value is hovering closer to the plan value, then life is easy. That means the project is going by and large okay. So let us proceed. Then okay, there is one more ratio coming in, that is the estimated completion, which is nothing but the total budget of a project. Sorry, this is a forecast. So let us see this particular snapshot. So here we are starting the project and this is the end date of the project. So this is the start and this is the end. The total budget of the project is 2 into 10, that is 20. So a new ratio is coming up. So budgeted completion is 20, which is the total budget of the project. And as on the review date, I'm supposed to complete work worth 10, which is the plan value, and earn value is 2 into 4, that is 8, and the actual cost is actual cost of work performed, that is 4 plus 2, 6 plus 1, 7 plus 2, 9. I'm not counting this because this work is not earned, so this is not earned. So actual cost is actual cost of work performed. So that particular work is not performed, so I'm not counting it. So in this context, we'll get plan value as 10, earn value as 8, and actual cost is 9. Now, using that numbers, we can work out schedule performance index is earn value by plan value, that is 0.8. Cost performance index is earn value by actual cost, that is 0.88. Now, estimated completion is actual cost plus budgeted completion minus earn value divided by CPI. So actual cost is 9. So 9 is here. So actual cost is 9. So here it will be 9. Budgeted completion was 20. That is total budget is 20. Earn value is 8. 20 minus 8 divided by CPI, that is 0.88. So in this case we are getting 22.63. That means when I complete the project, it is going to cost 22.63 instead of 20. If the nature of work remains the same and if the conditions remain the same, when I complete the project, it is going to cost me 22.63 instead of 20. So at least I get bad news very early here, so that I can take corrective action about it. One advantage of this is if you are a supplier, you should always ensure that the money you are collecting from your customer is by and large equal to the earned value of the project. Otherwise, you'll be spending money from your working capital. And at the same time, if you're a buyer, that means, okay, let's say you are buying a villa or a house or a flat. Please ensure that you don't pay them anything more than the earned value. So, so whatever money you're paying, okay, the project progress is in accordance with the money which is provided. So that way, the risk management becomes very, very easy and simple. So that is an advantage of this. So every day, instead of checking n number of reports, if you can maintain 2 ratios on your fingertips, that is SPI and CPI, and if you can ensure that these two are hovering around 1 all the time, then the project is going perfectly. So that is the beauty of earned value management. Questions, if any, please type in. I can answer them. Or can I assume that things are clear? Nobody has any questions? Okay, fine. So let us proceed, because sometimes it's tricky. People take a while to understand this. So if you're understanding it straight away, it is good. And questions, if you have any, either you can type now or you can send to me later. I can try to answer them. Yeah. Now the next question is from Nagaraju. He's saying, "Can you name few?" What is that? I do not understand that, Nagaraj. When you say, "Can you name few?" What do you mean by that? Yeah, every other project, the question is there any software tools to calculate earned value management? So every other software project management tool has it. MS Project has it, Primavera has it. Only thing is that the tool should be configured to do it, and the data should be provided on time. Then okay, you can have a meaningful thing. So the challenge is in defining the work packages, costing of the work packages, and somebody has to decide when this data will be updated, the actual cost, the actual data will be updated, who will update it. So that is a challenge. If the actual data is available, then okay, a tool can give you these numbers. And without understanding the significance of those numbers, you will not be able to use it for project management. So many organizations, what I've seen is once in a month these things are calculated and given to senior management as a health check of the project. So that way, if you have a system like that, it is not going to help you as a project manager in any way, because it is going to help only the senior management. So if you want to be a good project manager, you should have these numbers on your fingertips on a daily basis. Maybe cost variance and cost performance index may be really tough for you to get on a daily basis. So at least on a weekly basis, you should have those numbers. Whereas SPI and SP, the schedule related things, okay, that should be there on your fingertips every day. Otherwise, you cannot become an effective project manager. Yep. So many organizations have it, but then they are all collecting it once in a month to give a report to the senior management. My point here is, okay, these are great tools for the practicing project manager, so that that person can really use it, can manage the project better. So that is my view. Then the next question, okay, Primavera, is it the cost manager of Primavera? I've not used Primavera. So for me, if I have to really do this for small size projects, all you need is an Excel sheet. Okay, so on the x-axis, if you can put the task, and the y-axis if you can put the actual cost, and the x-axis the plan, you can always plot it out using an Excel sheet. So that way it is easy. Tools will give it to you, but then if you don't know what to do with this, or if you don't know what it indicates, then even the tool will not help. So that is the value I think this presentation will give you. Okay, now in this case we are getting this 22.63, which is bad news. That means when I complete the project, it is going to cost me 22.63 instead of 20. At least I'm getting bad news very early, so that I can pass on that bad news very early to the management. Maybe I have enough time to do some corrective action to recover from it. So those are all the advantages. So let's move on. Now there is another ratio called to complete performance index. So this is something new. So this was not there in the 3rd edition of PMBOK. In the 4th edition, they have included this TCPI, to complete performance index. This is nothing but BAC minus earn value divided by BAC minus actual cost. BAC stands for budget at completion. So in our example, BAC was, in our example, here our budget at completion was 22.63, and plan value was 10, earn value was 8, and actual cost is 9. So using these numbers, if you come back here, my to complete performance index will be BAC minus earn value. So BAC was 20, budgeted completion was 20 in our case. There is the total budget of the project, BAC minus earn value was 8. So this divided by BAC minus actual cost, 20 minus 9. 20 minus 9, so that is a ratio here. So that is 20 minus 8 is 12. 12 divided by 11. So this is going to tell me somewhere around 1.1 or so. So what it says is the remaining project, if I can maintain a cost performance index of 1.1, then still I'll be able to complete the project within 20. So we call it as a to complete performance index. Now based on the current snapshot, when we completed, when we did an estimated completion, it was 22.63 as per the previous slide. Now how do we recover from it? So for the remaining work, if I can maintain a cost performance index of 1.1, that means I should complete the remaining work without consuming the budget. And if the target CPI, if I can maintain at 1.1, that means still I'll complete the work within 20. So that's why it is known as to complete performance index. So the question is, okay, now Nagaraju has a question, is BAC and EAC are the same? BAC and EAC are not the same. BAC stands for budgeted completion. So in our previous example, if you see the budgeted so here budgeted completion was the budget of the project from the start of the project till the end of the project. So the total budget of the project was 20, that is BAC. Whereas estimated completion is the forecast we did. Going at this rate, when I complete the project, how much it is going to cost. that is 22.63. So BAC is the total budget of the project as of now, and EAC is the forecast we are making, estimated completion, which will tell us how much it is going to cost when we complete the project going at this rate. That means if the conditions remain the same, how much it is going to cost when I complete the project. So is that clear? BAC stands for budget at completion and EAC stands for estimate at completion. Okay. Now the second formula here is BAC minus earned value by EAC minus AAC. That means in case our estimated completion got approved by the senior management, then maybe instead of BAC I can replace that with the EAC. So this will tell me, okay, now what should be the target CPI I should be maintaining still to complete the project within budget. So TCPI stands for to complete performance index. So it is like a project is already incurred additional cost, and what should be the target CPI I should be maintaining for the remaining work, so that I can reach the destination still on time. That is the still within the cost. So that is the TCPI. Let's say I have a project which has the total value of the project is 100,000, and today I've completed only 50% I've completed, but then I've incurred 60% of the cost. Now, in order to complete the project within the original budget, what should be the CPI I should be maintaining? So that is that number, 2 CPI, TCPI. Is that clear? Yes. It stands for to complete performance index. So if I've incurred more cost, if I've overspent money till today, by not consuming the budget for the remaining activities, still I can complete, I can reach the destination on time. So this gives me that target. The second formula is, okay, now if you have completed EAC, if you have calculated the EAC, in our case it was 22.63, and let's say for that, if you have got approval from the management, then my revised budgeted completion becomes EAC, because EAC got approved by the senior management. So EAC becomes the revised budget. So in that case, what should be the target I should be maintaining? That is the second formula. That is provided my revised, the 22.63 got approved by the management as a revised budget. Then what should be the to complete performance index? That is the second formula. But I can just replace the budgeted completion by estimated completion. Yes, that's right, because I have now revised budget. So using the revised budget, if I less than 1 means it is a 0.9. It will be 1 actually. It will not be 0.9 because the rounding off only are getting 0.9. So because it gets revised, you'll get a number 1. 1 means okay, now it's okay because I need not cut corners because the revised budget got approved. So for the balanced project, if I can maintain a CPI of 1, then still okay, I'll be able to complete it within 22.63. So that is the idea. Okay, so this slide is redundant for our today's session, so I'm just skipping it. So with this, we are completing today's session. And if you have any questions, so now if you have to really implement this, we spoke about a work breakdown structure, and we spoke about work packages, and we spoke about work package sizing. All these things matters. Otherwise, what can happen is for a small project. Now, let's say you have a work package which runs for 2 months. then for 2 months time your earned value management will not show any variations, because if you are following a 0-100 rule, for 2 months it will remain at 0, because it will never become 100, because the work package itself is running for 2 months. So that way the work package sizing is very, very critical. For a very small project you should have smaller work packages, and for a large project you should have larger work packages. Otherwise earned value management will go for a toss. And another thing is, okay, now if the nature of work is not similar throughout the project, then earned value management can go for a toss. That means when I'm doing the excavation for a building, within that phase I can do an earned value management, that is perfect. But when I'm doing the foundation, within that phase I can do an earned value management. But if I try to do it across the all the phases of a project, then things can go wrong, because if I'm driving a vehicle on a level road, I'll get better mileage and I'll cover better distance. My productivity also will be much, much better. And suddenly I start driving on a mountainous road, my speed will reduce and my fuel consumption also will go up. So if the whole journey involves 80% of the road is level road, then the productivity numbers, CPI, all those things will be different. And suddenly I get into high ranges, then my speed will reduce and the expenses also will increase. The fuel consumption will increase. So that is a pitfall here. So don't try to apply earned value management across a project which has a tight compartmentalization of work, and the nature of work is also not homogeneous across these phases. Then earned value can fail. In that case, the only way is to implement earned value within that phases alone. Every phase, within a phase of you should calculate it. Across phases, don't do it if the nature of work is not homogeneous, because you'll get different. You'll be fooled by the ratios. That is one pitfall, and one package sizing is very, very critical. The company should have a system to count. That's a policy decision. Globally, all of you should agree whether it's a 0-100 or a 50-50. That is another major decision you have to make. So if you do all these things, then life is easy, because at the press of a button, you will get all these ratios, which can be used for professional project management. So another criteria here is your project management system should be integrated with your finance management system if it is a non-IT project, so that you get the actual cost at a work package level from your financial accounting system. But if it is an IT project where the biggest cost driver is the manpower, then you should have a tight coupling with the time accounting systems, so that the actual cost incurred at a work package level is available to you for the computation of earned value management. Otherwise, you'll end up doing a lot of clerical work. So if these things are taken care of, then the dividends from the earned value management system can be much, much better, and the project reporting becomes a lot easier, and as a project manager you can get some kind of a foresight into the future of the project, so that will make you more proactive, and you will get more time to take your corrective actions or preventive actions very early, so that will give you a better value. So with this, we are completing today's session, and we'll be having more webinars coming on our way in the future, and I hope it added some value to you. This presentation, yes, I'm recording this presentation, and if everything goes well, I'll be adding this to the PMRI campus channel on YouTube. Yeah, thank you very much. Thanks for your time, and hope this will help you for improving your project management as well as for your PMP certification preparation. Thanks.